Hi guys, thanks for tuning in to another episode of Nuggets News. In today's video, I'm going to clearly explain options and how you can actually trade Bitcoin options now on FTX. So as you know, this is an exchange that I saw very early on and I knew they were coming out with these awesome products, and it's great to see this space maturing. Options are complicated financial instruments, and I know some people are interested. They don't know how to get their head around them. So by the end of this video, I'm really hoping that I can clearly explain exactly how they all work. Now, we're also going to have a look at their prediction markets. They've currently got that presidential 2020 election market where you can also trade the probabilities of who is going to get elected. And I'm sure they're going to come out with other prediction markets in future. So today's video is really all about probabilities, and that is what options are. It's how they work. If you haven't used FTX before, I'll link my basics tutorial down below that just explains the different order types and how to place those, because just like trading different coins, you have to place orders and use stop losses and this, that, and the other when we're trading these prediction markets as well. Since we first did that video, FTX have added Aussie dollars and a number of other currencies, so you can link your bank account and deposit or withdraw to take your profits. Just click on that OTC tab and type in whatever currency you want. Now, we've also got that link below to get you a double discount on fees, and we're working on another promotion with the guys, and everyone that uses our link will be eligible for that other promotion. All right, so let's talk about standard deviations of data. Now, this is a standard distribution graphic, and it shows us any set of data. Now, that might be Bitcoin's price, the likelihood of something to happen, or it might be how tall average men are in Australia, for example. And we say, well, the average person is around 1.80 meter tall, but we know that the vast majority of people, we might say 95% of people are between 1.60 meter and 2 meters tall. So that would tell us that that's two standard deviations of data gives us 95% of that data capture. So this is how standard deviations work. You might have seen Bollinger Bands on my charts. Bollinger Bands are a two standard deviation visual representation of where price should go. So when we go outside the Bollinger Bands, we know that, well, that only happens 5% of the time. That's why we're likely to get a mean reversion or a bounce or a pullback, depending on if we're above or below those Bollinger Bands. So let's have a look at the two different types of options. And this is where people start to get confused with all the different names. So I'm going to give you a very basic rundown today of the call options and the put options. And you don't need to worry about the different Greeks. So options get their pricing from a lot of complicated math. Now that has to do with things like interest rates, volatility, time decay. So you're going to pay more for an option that gives you 2 years to be right than an option that only gives you 1 month to be right, as well as delta and gamma. So don't worry too much about the options Greeks. If you're a very beginner, in our members group, head over to the units tab and click on options education, and I've done some really deep dives into how they all work in those explanations. Now, I know some of you don't like Facebook, so our new members portal on our website and the Nuggets News app is going to be out in the coming weeks. All right, so let's head back over here and let's explain a call and then a put option, the two different types. The way I want you to remember it is a call is the option to be able to call up your exchange or your broker in future and say that, hey, I want to be able to buy at this price. So if we think Bitcoin's going to go up past $20,000 at the end of the year, we might say, let's buy a $20,000 Bitcoin call option for the end of the year. And if Bitcoin goes to $100,000, that's fantastic. We can call up our broker and say, hey, I bought the option to buy Bitcoin for $20,000 and now it's $100,000. So I get to buy a Bitcoin for $20,000 even though price is $100,000. That was a fantastic options trade. Now the opposite is a put, where we want to sell in future. And you can remember this as, I want to put the Bitcoin or the stock, put it back to the exchange or put it into the order book at that price. So if we think price is going to fall and Bitcoin's currently $10,000, we think that there's a bit of a correction looming ahead. Well, we say, I'm going to buy the $10,000 Bitcoin put for next month. And then Bitcoin falls, it's down to $6,000. That was a good options trade. We can put that Bitcoin back into the market and someone has to pay us $10,000 for that, even though Bitcoin's now only $6,000. So who is paying us that difference? Well, it's the person that was on the other side of that trade. So not only can you buy a call or a put, but you can take the other side of that trade and sell someone a put or a call. Now, obviously, that's way more dangerous, and advanced users, you guys should be the only ones that are even thinking about doing this. Because if Bitcoin goes to 100,000, you've got to give that person a Bitcoin. You got to find that difference. Same as if Bitcoin crashes, you've got to sell someone at that other price or buy it off them if you sold them the put. So hopefully that makes sense. Call up and buy, put it back into the exchange at that price. So let's head over and let's do an example of these two different types of trades. This is just the Bitcoin price on a chart here. We've clicked on the options tab. Let's scroll down and click on request quote. So let's do a bullish trade to start off with. Let's say that we do think Bitcoin is going to go into a bull market after the halving, and we think it's going to go to $100,000 by the end of the year. So we would type Bitcoin. At the moment, that's the only coin we can do options on. Call option, $20,000 strike price, 12th, the end of the last month of the year, 31st, the last day of the year. We want to buy that call option. We don't want to sell it to someone else. That's a bit too risky for us today. And we only want to do a size of 1. So let's request a quote. That's going to pop up here in my requests. And the exchange now using all the data and all that math that we just spoke about, the advanced side of things, to calculate what they think is a fair price based on the probability of this happening. So at the moment, I can buy that option for $830. So if Bitcoin goes to $100,000 by the end of the year, I can ring up and I can say, hey, I want to buy that Bitcoin for $20,000. You've still got to pay $20,000 for the Bitcoin, but now that it's $100,000, that's a bargain. I'm pretty happy getting to buy a Bitcoin for $20,000 if price is $100,000. That's a fantastic options trade. So you've got to weigh up if you think that is a good price to pay for the probability of that event happening. So let's just click on the trash can there and let's do another option trade. This time, let's do a put. So we might say that Bitcoin's at $10,000. Price, we think, is going to have a correction in future. So we want to be able to sell or put this back into the market at $10,000 in case there's a fall in future next month. So let's buy that option and let's click on request quote. Now, at the moment, Bitcoin trading around 8,700. We're going to pay quite a bit because Bitcoin's already below that price. So we're going to pay $1,700 for the option to be able to sell someone a Bitcoin for $10,000 2 months from now. So if Bitcoin was to keep crashing, obviously this trade will become better and better for us, almost like insurance. Buying puts are like buying insurance in case your portfolio has a fall in future, and you can hedge this way. So let's do a more advanced trade. Let's actually sell someone a put. Let's say put $7,000. We don't think that Bitcoin's going to go down that low in the next 2 months. We're really bullish. So we're happy to sell someone this option. So instead of buy, let's change that to sell. Let's just do a size of 1, request a quote. And we can actually get paid up front for doing this. So we can get paid $194 and we get to keep all that money as long as Bitcoin doesn't fall below $7,000. Now, if it does, the person that bought that put, that hedge or that insurance, they're going to ring us up, or we're going to get a little tap on the shoulder and say, hey, I want to put my Bitcoin into the market for $7,000 because now price might be $4,000. And again, we've got to buy that off them for $7,000 because we took the other side of that trade. And that is why these selling of options has far more risk. So I hope that makes sense. The put option, the call option, the buyer and the seller who takes the other side of that trade to make directional guesses about dates and times, prices in future. So next up, we want to have a look at these prediction markets. Now, these are actually very easy to understand. All we're looking at is the price of a token, which is the percent of them getting elected, the probability. So at the moment, Bernie is around a 21.8% chance of getting elected. If he gets elected, that jumps up to $1. So that would be around a 5x return. Whoever loses these elections or drops out of the race, their token price is going to go to 0. So let's have a look at Trump. At the moment, he's around a 62.7% chance of getting elected. If he wins, it goes up to $1. If he loses, it goes down to 0. So if you're really confident that Trump's going to get elected, not only can you buy this token, but you can actually buy it on leverage, just like we buy Bitcoin on leverage. So with leverage comes more risk. You have to put up more collateral, all the usual things I spoke about in our initial tutorial, but that's how these markets work. Now, the reason I like these over traditional markets is simply because the odds are way easier to understand. When we look at Trump here, $1.69, that doesn't really tell me much about the percent likelihood of him getting elected. This is just a number. So if we bring up our calculator here, those of you that remember your high school statistics maths, you'll know that to work out the probability, we would go $1.69 divided by 1 plus the odds. So that would be 269, and that gives us around 62.8%. Very, very close to what we're currently trading on FTX. Now, a few weeks ago, there was actually a bit of a difference. So some of you might want to arbitrage that opportunity, but these are all the things that are possible. I just love that FTX is coming out with these products. If you actually want to bet that someone's not going to win, you can short these as well. So we can click on Bernie. We don't think he's going to win. We can short that market and bet that that token is going to go to zero. So when we make money on the way down, those of you that are familiar with shorting, you understand these concepts by now. We might want to short $100 of this token. Then it goes to zero. We get to keep that whole $100. So it's very easy to understand. Binary events at the moment. With options, the last thing I'll just mention is that these can be exercised at any time. So you don't have to wait till the last day of the year in the example I gave. You can exercise the option to do so at any time, which is different to those scammy ads you've probably seen pop up for binary options, which only can be traded on the end date, the expiry date. So I hope that all makes sense. Remember to use that link below to get the double discount and to qualify for that other promotion we are going to be doing with FTX. For more information on anything we do, head over to our website. Otherwise, guys, smash that like button, subscribe if you haven't already, share this video around, and I'll talk to you again soon. Cheers.